The coalition government claims China is backing Anthony Albanese in the next federal election. National Australia Bank shows why investors like it so much among the big four banks, and plenty of earnings results. It's Friday, the 11th of February 2022. Welcome to Fear and Greed, the business podcast that sets you up for a successful day. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Then stay listening for Sean's chat with media and radio personality Gus Worland about his very personal fight to help men become mentally fit. It's something a little bit different for Fear and Greed, but it is well worth listening to. It's a really powerful interview. But first, Sean, our lead story today is all about the goings-on in Canberra. Defence Minister Peter Dutton made some pretty extraordinary allegations in Parliament yesterday about opposition leader Anthony Albanese.
Yes, he said China is supporting Mr. Albanese to become Prime Minister. He said there was evidence that the Chinese Communist Party and Chinese government had made a decision about who they'll back in the next federal election. Of course, Mr. Dutton offered absolutely no evidence to support the claim. Mr. Albanese said the comments were not acceptable, nor were they in Australia's national interest. Earlier, the Prime Minister, Scott Morrison, who has maintained a very hard line against China, said Mr. Albanese was looking to appease Beijing. Michael, it's already getting grubby.
Yeah, and we've still got probably 3 months until the election. And meanwhile, Sean, the federal government's religious discrimination laws weren't debated in the Senate yesterday. Does this mean it's all on hold?
Probably. They eventually passed the House early yesterday morning after 5 coalition members crossed the floor to support Labor amendments for better legal protection for transgender students. But they didn't make it to the Senate, and the federal government is now likely to push for a Senate inquiry into key parts of the bill. That means it will be held up. Certainly it won't pass before the next election. All in all, it's a bit of a loss for the Prime Minister, Scott Morrison, who has stridently been pushing this legislation.
And there were some big changes to how proxy advisors work. They were due to take effect from the 1st of July. You explained how they work last week, but they got rolled in Parliament yesterday.
Yes, they did. The government was trying to push through legislation that meant proxy groups had to be independent of clients. Now, proxy groups advise shareholders, including super funds, on how to vote on company matters such as remuneration and governance issues. The new legislation also called for the advisors to disclose recommendations to companies at the same time as they advised clients of their opinions. Now, penalties for not doing so were going to be as high as $11 million. Business really liked the legislation. It meant they'd get a heads up on what shareholders were hearing and how they might vote. But Labor, and certainly the superannuation industry, didn't. In the end, Independent Senator Rex Patrick moved to disallow the regulations and the vote was passed. That's a very big loss for Treasurer Josh Frydenberg, who has been pushing this legislation for months.
Yeah, it certainly is. How did local equity markets go yesterday?
Well, the S&P ASX 200 closed the day up a touch to 7,289 points. There were plenty of moving parts thanks to the flood of results being released at the moment. I'll get to several of those shortly, Michael. Away from earnings, the banks did pretty well. Fortescue Metals was up nearly 4%, while Rio Tinto jumped 2%. Macquarie Group, Aristocrat Leisure and Sonic Healthcare were all down a couple of percent.
And what's happened overseas?
Well, Michael, Wall Street fell after figures showed that US consumer prices jumped 7.5% in January, a 40-year high. The number was expected to be big, but not that big. Core inflation, which removes volatile items, was up 6%, also the highest since 1982. It means the US Federal Reserve could lift interest rates more quickly than originally anticipated and in larger increments. Higher energy costs, labour shortages and supply disruptions, coupled with strong demand, are pushing prices up. The inflation reading triggered a fall in the share market, and in early afternoon trading, the broad-based S&P 500 and tech-heavy NASDAQ were both down around 1%. The US dollar also sold off against other currencies. In the short term, currencies tend to appreciate, not sell off, when higher interest rates are coming around, but that didn't happen overnight. The Aussie dollar continues to perform well, and it's trading above 72 US cents. Remember, last month it fell towards 69 US cents on the back of expectations that US interest rates will rise, and since then it's climbed slowly. Of course, it's still well below its peak of 80 US cents, which it touched a year ago. Finally, European markets were mixed overnight, while Brent crude and gold prices both rose.
All right, we'll be back in a moment with the rest of the day's business news. Plenty to talk about this morning, Sean. National Australia Bank was the fourth bank to provide a trading update over the past week. Would have been a tough act to follow the Commonwealth Bank the previous day with their surprise profit. But how did NAB go?
Well, it did pretty well, really. Cash earnings for the quarter were $1.8 billion. That beat market expectations, and it triggered a 4.3% jump in its share price. But just like the other three, Commonwealth Bank, Westpac and ANZ, NAB's profit margins have been squeezed. Unlike Westpac and Commonwealth Bank, National Australia Bank said costs were higher as well, in part from higher pressure on salaries. The Melbourne-based bank said lending to homeowners and small and medium-sized businesses was growing. So, what have we learned from the big four banks over the past week? Well, the mortgage market is very, very competitive, and there are some very good deals out there. Take advantage of them now. Same deal in business lending. Two of the big four, Commonwealth and National Australia Bank in particular, are working hard to do more business with small and medium-sized businesses. Profit margins are being squeezed across the board. Cost control is really important for all the banks and how they'll perform for the rest of the year. And overall, the bank bosses think the economy will accelerate and interest rates will rise over the next 12 months or so, and that should be good for bank earnings. All in all, a sector that's in pretty good shape, with National Australia Bank and Commonwealth Bank being the pick of the lot.
Yeah, great summary. The COVID news, Sean, continues to improve, with cases falling and restrictions being lifted in some states as well.
Yes, Queensland Premier Anastasia Palaszczuk said she was happy for international tourists arriving in her state to have just 2 vaccine jabs without a booster. After announcing 5,900 new cases and 8 deaths yesterday, Ms Palaszczuk said the Omicron wave had now peaked in her state. In South Australia, new rules come into effect from Monday, whereby 50% of workers will be allowed back on site, up from the current limit of 25%. There's also an easing of restrictions on home gatherings and gyms. Case numbers in New South Wales and Victoria were 10,300 and 9,900 respectively, with 40 deaths across the two states. The trend line in both New South Wales and Victoria is down, and of course that's very good news.
Sean, one of the worst performing stocks of 2021, and we talked about this a fair bit last year, was AGL. Now, the energy giant is on track, it seems, to split into two later this year as part of its efforts to get back on track.
Yes, that's right, and it reported its earnings yesterday. Now, as you mentioned, plenty went wrong for AGL last year. Its CEO outlined a split into two, separating the greener assets, which was the retail business, from the fossil fuel assets. That CEO then resigned. The gas and electricity producer was really unloved by investors because of its dependence on fossil fuels. It's the biggest generator of coal-fired power in the country. At one point late last year, AGL had lost 80% in value over the previous 5 years. Incredible. But since November, the company's share price has bounced. In fact, it's up nearly 50% from its lows. Surging gas and electricity prices has helped, so too a more settled management team, and already announced plans about who would run the two new businesses when they're eventually separated later in the year. Yesterday, AGL said it was bringing forward the closure dates of 2 of its big coal-powered generators, and while its underlying profit fell 41%, it was actually a better result than some analysts had forecast. All in all, though, its share price dropped 3% today, but it's kind of good to see AGL back on its feet again.
Yeah, it certainly is. Now, one of the top jobs in Australian business is to run the Australian Securities Exchange, aka the ASX, and its long-term boss, Dominic Stevens, is stepping down.
Yes, Mr. Stevens has been around financial services for a few decades now, and he's leaving after running the ASX for more than 5 years. Mr. Stevens is widely thought to have done a pretty good job, notwithstanding a hiccup in trading late last year and an unfinished project which is supposed to upgrade the current CHESS clearing and settlements business. He said he wasn't able to commit to another 5 years in the job and decided to step down. Now, the announcement came as the ASX reported a strong start to the year and upped its dividend for the 6 months to the end of December. The business of the ASX, as opposed to the actual exchange itself, goes really well when there's high trading volumes, and that's what you get when there's volatility in the market. The group made a net profit of $250 million for the half year, but the CEO announcement didn't impress investors, and in the end, its share price fell nearly 4% yesterday.
Now, we've talked about a few companies already, Sean, but one that would be watched pretty closely would have to be AMP. They got a new CEO last year. They've had a pretty extraordinary few years leading into that. The company reported results yesterday. How did it go?
Well, it announced a $252 million loss thanks to a number of impairments and write-downs, but the bigger news is that the company confirmed a number of suitors were circling its asset management business, AMP Capital, which is actually going to be known as Collimate Capital. AMP's current plan is to spin that business into a separate listing on the ASX in the next few months. The confirmation that people were looking at the business helped trigger a 6% jump in AMP's share price yesterday before closing up 5%. Now, the $250 million loss was expected given the money it's had to repay, write down and had to sink into reorganising the business. If you exclude abnormal items, those sorts of items, AMP's annual profit actually jumped more than 50%, with the banking and asset management business doing well. Earnings from the wealth management business, however, didn't do so well. All in all, it was actually a pretty good result for AMP, particularly given what we've been talking about the last couple of years.
Collimate Capital, did you say?
Collimate, yeah.
It's an interesting name. Doesn't stand out quite as much as AMP Capitals, but I suppose AMP has a bit of history behind it, doesn't it?
Yes, I don't know where it's from, actually. I'll look into it.
And we'll report back on that one next week, Sean.
Good.
Okay, Sean, what's making headlines in today's news media?
The Australian Financial Review is reporting that US Secretary of State Anthony Blinken has declared the Indo-Pacific will shape the century as he reaffirmed America's commitment to the region. Meanwhile, Japan's foreign minister warned it confronted a severe security environment brought on by China's rise. The comments were made ahead of today's Quad foreign minister meeting, which of course involves Australia's Marise Payne. In several media outlets this morning are reporting that Prince Charles has been reinfected with the coronavirus, triggering fears about the health of his mother, Queen Elizabeth II. Apparently the two met recently, although the Queen thus far is not showing any COVID symptoms.
All right, running through some of the other stories around today, Integrated Services Group, Downer EDI, which does lots of work in infrastructure and transport, announced a drop in revenue but a sharp jump in net profit. Its biggest challenge, according to CEO Grant Fenn, is labour shortages, thanks to Omicron delaying new projects. Its share price finished yesterday 2.3% lower, and engineering and construction group CIMIC said revenue was up nearly 40%, but profits were 35% lower. That's because last year's profit was artificially boosted by the sale of an asset. The group's share price fell by more than 7% yesterday.
Mirvac is one of the largest property companies in the country, and in the second half of last year, revenue jumped 38% and profit was up more than 40%. While lockdowns hit its retail properties, its development businesses in residential and commercial did really well. It's one of the quirks of the COVID outbreak. While the property market was hit really hard, particularly retail, development across the nation didn't slow down very much.
Sean, it really is a bit of a results fest today, isn't it? We have results coming out our ears. The NBN Co said new customer acquisition and demand for higher speed tiers underpinned a bumper profit of $1.5 billion for the December half. NBN, of course, is owned by the federal government. And the country's second largest gold digger, Northern Star Resources, announced a lower than expected profit on the back of higher operating costs. See what I mean? It is a results fest.
A bumper season for analysts.
It certainly is. Now, what's the key overseas news this morning?
Well, the World Health Organization has nominated the middle of this year as the date for bringing an end to the acute phase of the COVID-19 pandemic. By then, 70% of the population of every country should be vaccinated, if countries choose to allow that. If that's to be achieved, the disease is likely to not be eradicated, but to become seasonal. The wild card, of course, is the development of another variant more infectious than Omicron. Japan will divert cargoes of liquefied natural gas, LNG, to Europe after requests from the United States and European Union. The shipments are expected to arrive next month and will act as a reserve in the case of conflict breaking out on the Russia-Ukrainian border. Now, remember, Australia has offered to provide LNG to Europe if needed, though that hasn't been taken up at this point. Finally, Michael, Walt Disney has eased concerns the streaming video boom is running out of puff after reporting strong subscriber growth for Disney+. Now, remember, a couple of weeks ago, Netflix indicated its subscriber growth had slowed. Disney said it's confident that new releases, such as Obi-Wan Kenobi, later in the year, will bring in more viewers. Disney's earnings from its theme park and resorts division have also rebounded. I can't not say that again. Obi-Wan Kenobi, he was my all-time favourite character when I was growing up. Apparently, there's a whole new series on him.
It will be very good. I don't know. I just don't know whether these streaming services have run out of puff yet. I don't know. It feels like we might be at peak streaming now, but to me, that's just being spoiled for choice. It's not like we're running out of options.
Great for the consumer. You would think that some of them have to fold, though, because there are so many out there at the moment.
You know what else, Sean? I went to the movies for the first time in about a year the other day, and suddenly you get so used to streaming and watching everything at home that you forget how good it actually is to go to the cinema.
Yes.
And so you think as more movies start to return to the cinemas and more people start to go there, that kind of thing will probably have a bit of an impact on Netflix and Disney Plus and the other streamers.
Yeah, I'd imagine so.
Okay. Now, up next is the Fear and Greed Daily interview. And today you're speaking to Gus Worland. I mentioned it at the top of the show. It is something a little bit different for Fear and Greed to be talking about an issue like men's mental health and mental health more generally. But this is such a powerful interview, Sean.
Yes, Gus, of course, is a radio personality. He started Gotcha for Life after being very personally affected by the suicide of, well, what he says is kind of a second father to him. And he's done an incredible job of bringing mental fitness, as opposed to mental health, he likes to call it mental fitness, to the fore. Great anecdotes, great stories just about how much he's touched people's lives. Just please listen to it and share it.
Yeah, absolutely. It's a really, really quite an emotional chat. That's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you very much, Sean.
Thank you, Michael.
It's Friday, the 11th of February, 2022. Make sure you're following the podcast and join us online on LinkedIn, Twitter and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.